The Nasdaq is currently closed, but the last reported price for Opendoor Technologies Inc., ticker OPEN, was $7.05 as of December 8, 2025, in after-hours trading, reflecting a marginal dip of 0.43% from the official close of $7.08. Now, the common expectation is that Opendoor is simply a highly leveraged iBuyer, a fancy word for a high-tech house flipper, which will be crushed by elevated mortgage rates and a slowing housing market. The reality, which often gets buried beneath the surface-level anxiety of macroeconomic data, is that Opendoor is quietly shifting its operational focus in a way that fundamentally alters its relationship with the housing cycle. It's an unexpected pivot from capital-intensive inventory accumulation to a more capital-light marketplace model, particularly through its third-party services, which has the potential to decouple its stock performance from the immediate whims of interest rate hikes. This is not to say the housing market doesn't matter, but the traditional bearish thesis, which is currently the dominant narrative, might be missing the evolution of the business model itself, which is what we need to dig into right now. The immediate stock movement over the past few weeks illustrates this tension between the old perception and the new operational reality. The stock has been highly volatile, seeing huge swings on relatively modest news, a characteristic of a stock with high retail interest and significant short seller attention. For instance, the day the Fed hinted at keeping rates higher for longer, the stock saw a dramatic pullback, which is the market acting on the old assumption: higher rates kill iBuying. However, that dip was met with equally aggressive buying, suggesting institutional money, or at least a powerful fraction of it, is now keying in on Opendoor's cost-cutting initiatives and its improving unit economics. The daily volume has been extraordinarily high, often well over 100 million shares, indicating a furious battleground between long-term growth buyers and speculative short-term traders. This high volume, especially on days where the price manages to hold despite macro headwinds, is a critical sign that the selling pressure is being absorbed by persistent buyers who see something beyond the current cycle. The broader market consensus, particularly among legacy financial analysts, positions Opendoor as a highly cyclical stock, tethered directly to the mortgage rate curve. Their argument is straightforward. If borrowing costs are high, Opendoor's cost of capital goes up, its inventory sits longer, and it's forced to sell at lower margins, hence the persistent losses. They point to the declining revenues reported in recent quarters, a natural consequence of scaling back purchases in a volatile market, as proof of the broken business model. But here is the contrarian take that forces a rethink. The company used the housing slowdown to aggressively optimize its pricing algorithms and operational efficiency. The goal shifted from simply acquiring high volume to executing profitable transactions. This is where the unexpected insight comes in. Opendoor is reporting a substantial improvement in its adjusted net loss figures, driven by better pricing accuracy and lower operating expenses per transaction. In short, they're getting much better at the core task of underwriting and managing risk. While the quantity of homes sold is down, the quality of their execution, which is what matters for future profitability, is demonstrably up. To understand Opendoor, you have to look at its core business model. It is a digital platform that aims to be the simplest way to buy and sell a home. It buys houses directly from homeowners, the iBuying part, performs light repairs, and resells them. It also generates revenue through ancillary services like title and escrow, and is increasingly moving into a marketplace model where it helps connect buyers and sellers through its platform, but without taking on the inventory risk itself. This move toward a capital-light strategy, generating fees from transactions rather than relying solely on the profit margin of a home sale, is the key structural change the market is beginning to notice. The business fundamentally operates on the spread between the price it buys a home for and the price it sells it for, minus holding, renovation, and selling costs. The historical problem has been that this spread was often negative when the housing market turned, leading to massive losses. Their new leaner model, refined by the AI and machine learning they employ for pricing, is designed to keep this spread positive even in a softer market, a claim that the recent earnings results appear to support. Older reports will show periods of explosive growth, particularly in 2021 and early 2022, but those growth figures were achieved with less focus on margin and are largely irrelevant to the current situation. What matters now is the structural efficiency achieved during the recent housing market retrenchment. This brings us directly to the short-selling dynamics, which are absolutely central to the Opendoor narrative. This stock has been a short-seller magnet for years, and it remains one of the most heavily shorted stocks on the Nasdaq. The short interest is significant, hovering around 16% of the float, which is a very high figure compared to the average stock. Short sellers, like the analysts we just discussed, fundamentally believe the model is unworkable in an environment of high interest rates and that the company will eventually need to raise more capital, diluting existing shareholders. Prominent figures in the hedge fund community, though names are rarely publicly confirmed with recent data, have long held bearish positions, citing the inventory risk and the cyclical nature of real estate as insurmountable hurdles. The sheer number of shares sold short, at over 127 million shares based on the last reporting period, tells you there is a massive collective bet against the company. This huge short position, coupled with the stock's relatively low days-to-cover ratio, sitting around 2 days, suggests that while the short volume is high, the liquidity is also high, meaning it wouldn't take an extraordinary effort for shorts to cover their positions quickly under normal circumstances. However, the CEO's recent post-earnings comments about taking actions to ruin the night of short sellers, specifically through the distribution of stock warrants to existing shareholders, has injected a high level of speculative retail interest, turning the short thesis into a live market debate. The goal of issuing these warrants is both to reward existing shareholders and, more pointedly, to make holding a short position more expensive and complicated, as the short seller must either purchase the distributed security or be responsible for the cash equivalent, adding an unexpected cost to their trade. This move, a clever psychological and financial tactic, is exactly the kind of event that retail investors, who frequent platforms like Reddit's Wall Street Bets, view as a battle cry. The retail sentiment is unequivocally bullish on the short squeeze potential, seeing Opendoor as the next high short interest stock ready for a parabolic move, especially with the CEO openly challenging the bearish camp. For investors, the actionable insight here is simple. You must look beyond the short interest percentage itself and focus on the borrow rate and the volume trends. The short borrow fee rate for Opendoor has remained surprisingly low, hovering around 0.43% recently. A low borrow rate signals that there is ample supply of shares available to borrow from lending institutions, which typically dampens the likelihood of a massive forced short squeeze based on supply constraints alone. For retail traders looking for a squeeze, a rising borrow rate is a key signal to monitor. Its continued low level suggests the fundamental short thesis risk, rather than the mechanical short squeeze risk, is the dominant factor. Investors should track option open interest, particularly in the call options, as a spike in bullish bets far out in time could signal large coordinated buying. What's your take on the rising short interest and the CEO's comments? Smart money recognizing a valuation problem, or simply fear being pushed by a desperate few? Comment below. Looking ahead, the future outlook for Opendoor is a clear battle between capital structure and market efficiency. The bearish reality is that the real estate market is still fragile, and the company is still losing money, even if those losses are shrinking. They have reduced their inventory risk by selling off thousands of homes in a challenging environment. But the cost of that deleveraging shows up as realized losses on the balance sheet. The key catalyst for the stock is the continued progress of its new capital-light model. If Opendoor can demonstrate consistent profitability on a unit economics basis, proving its algorithms can accurately price homes for profit in any rate environment, the market will be forced to re-rate the stock from a cyclical real estate play to a high-margin tech platform. This is the expectation that must be met for the stock to sustain a move well above its current trading range. A successful quarter that shows growth in high-margin ancillary and marketplace revenue rather than just volume would be a massive blow to the short thesis. The specific opportunities and risks are finely balanced.
On the opportunity side, any substantial decrease in the Federal Reserve's benchmark rate could serve as a powerful external tailwind, significantly lowering Opendoor's borrowing costs and immediately improving its margins without the company doing anything differently. Another opportunity is the further consolidation of the iBuying space, as major competitors like Zillow have already exited, leaving Opendoor in a stronger, if still challenging, competitive position. The main risk, however, is a prolonged economic downturn that leads to a sharp and protracted decline in home values, which would re-expose the company to large inventory write-offs. Retail investors should find short interest data from financial data providers or even directly from NASDAQ, paying close attention to the bi-monthly updates on the short position and daily changes in the borrow rate. They must recognize that chasing a short squeeze is a high-risk endeavor. While the narrative is powerful on social media, the fundamental risk remains until the company achieves sustained quarterly profitability. Do not mistake high speculation for strong fundamentals. In summary, the core tension in